Hello. You're listening to the Bitcoin Advocate podcast. I'm your host, Andy, and if you're new here, welcome. This is a show where we discuss all things Bitcoin on a weekly basis. This is the show that I wish I had when I first got into Bitcoin, which is why I started this podcast. This is your one-stop shop of complex topics in the wonderful world of Bitcoin, explained in simple ways. As a reminder, this show is available on YouTube, Spotify, Amazon Music, and a whole bunch of other platforms. So, wherever you might be listening from, if you like the show, be sure to follow and subscribe. You can also follow me on Twitter at twitter.com/thebtcadvocate. Today's episode is sponsored by myself. More specifically, I have a book about Bitcoin called Hyper-Bitcoinization, a story about a revolution. And if you're watching this on YouTube, there's a link down below in the description. Otherwise, you can search for the title on Amazon and it should be the first result. It's not selling out if it's my own product. Last week, we talked about the gold standard and why it just doesn't work. We discussed how the shortcomings of using gold as money led us down a path that would eventually become our modern fiat monetary system, which has created its own slew of problems in our society. This week, we'll discuss the benefits if we were to adopt Bitcoin as our monetary standard, a Bitcoin standard, if you will. I'd like to begin today's episode with a thought experiment. Imagine if you had two employees of the same company, Alice and Bob. And for the sake of argument, let's just assume that everything about their income and expenses are the same. So they have the same job title with the same amount of hours that pays them the same, and they also have the same bills to pay. Suppose the only difference between Alice and Bob is that Alice takes 100% of her pay in Bitcoin, while Bob takes 100% of his pay in good old fiat currency. Suppose if there's a bill that Alice needs to pay which cannot be paid in Bitcoin, assume that she can just convert the Bitcoin to fiat at whatever the market price of Bitcoin is at that moment without accruing tax liabilities. Then, according to data from Charlie Bilello, the founder of Compound Capital Investors, if we were to take the 10-year period between 2011 and 2021, Bitcoin has returned an annualized 230% against the US dollar. In the meantime, it is estimated that the S&P 500, which is consisted of the 500 largest companies in the United States and generally used as a benchmark for the American stock market, returns about 8 to 10% annually over the long term. So I think it's safe to say in the past 10 years or so, Alice would have made significantly higher returns just by holding Bitcoin and doing nothing else. This is despite Alice and Bob having the same income. Worse, if Bob had not invested the money and simply held his salary in fiat the same way that Alice had held her Bitcoin, the average savings account throughout the past 10 years has rarely yielded above 2% annually, and Bob would have been lucky to just keep up with inflation. This may just be a thought experiment, but similar scenarios are playing out in real life. Imagine if you were in Bob's shoes and you saw a coworker who has the same role and income as you skyrocket in net worth just by making a simple change such as getting paid in Bitcoin as opposed to fiat. This creates an imbalance. You begin to question whether or not you should take at least part of your pay in Bitcoin as well. And I would bet in such a scenario, all your other coworkers who are also taking their pay in fiat are thinking the same thing. This imbalance creates what's called a flywheel, or the more scientific name, a positive feedback loop. A positive feedback loop is where the output of a system is the input that is needed for that system to keep going. So for example, getting paid in Bitcoin is a positive feedback loop because as more people see the benefits of Bitcoin, more people demand it. And that increases the pressure for companies to purchase Bitcoin to pay its employees. Since Bitcoin is limited in the amount that it can ever exist, the extra demand for Bitcoin inevitably drives up the price, leading to more people demanding to get paid in Bitcoin instead of fiat. Keep in mind this flywheel does not work for everything. For instance, it would not work for gold, since if the demand for gold suddenly skyrocketed, the gold miners would just ramp up more efforts to mine gold and the supply of gold would increase. And this would cause the price of gold to decrease again as the supply increases. This is not possible for Bitcoin, since the new supply emission for Bitcoin is algorithmically determined. Right now, at the time of this podcast, it is 6.25 Bitcoin per block, and each block takes approximately 10 minutes to confirm. So if you work out the math, that's just about 900 Bitcoins per day, every day. until the next halving event, which will occur by current estimates sometime in March or April of 2024, where this block reward will be cut in half. So from spring of 2024 onwards, it will only be 450 Bitcoin per day approximately. The difference is that Bitcoin has a mechanism where the difficulty of mining Bitcoin is automatically adjusted to target the network always taking approximately 10 minutes to solve the proof of work that is needed to confirm the next block of transactions. We'll discuss why that the block time is 10 minutes is important and why we can't just make it faster in a future episode. But for now, the point I want to make is that Bitcoin is the only asset where if the demand skyrockets suddenly, there is no way for the supply to catch up to demand by method of getting new supply. In economics, this property is described as elasticity, and Bitcoin's supply is completely inelastic, meaning that the supply cannot respond to changes in demand because the supply is fully determined already. The reason why this inelasticity is significant is because the only logical response to a sudden increase in demand of something where the supply is inelastic is for the price to go up. Putting it in simple words, if you're trying to buy, let's say, Beanie Babies, and there's a stockpile of it somewhere, however, since the product got discontinued, there's no more new supply coming. So even if there's a large stockpile, if a lot of people want to buy Beanie Babies at once, what happens to the price? Whenever you're looking for breakthrough innovations, it is important that you look for these positive feedback loops. And I'm not just talking about Bitcoin. Think of any technology product that has changed the way we live, and you'll most likely find a positive feedback loop somewhere. Facebook is only valuable because once you join it, if your friends want to talk to you and interact with you online, then they gotta join it too, which prompts their friends to join it, and so on. You can see similar patterns for smartphones, fax machines, Blu-ray discs, email, the list goes on. For Bitcoin though, the Bitcoin salary flywheel is not the only one. In 2021, Tesla, the famous electric vehicle and renewable energy company, decided to allocate $1.5 billion of cash on their balance sheet to Bitcoin. At the time, this represented about 7.8% of Tesla's total cash position, and this news sent Bitcoin's price skyrocketing almost 20% instantly. Once again, recall what we just talked about regarding the supply inelasticity of Bitcoin. If the demand suddenly skyrockets, the only logical consequence is that the price also skyrockets since a proportional amount of new supply cannot be created. So this whole companies buying Bitcoin thing is another flywheel. At the time that Tesla made their Bitcoin purchase, Apple was the most valuable company in the world, coming in at a market cap of around $2.5 trillion with a cash balance of around $60 billion. If Apple were to just allocate 5% of their cash to Bitcoin, that would represent double the size of Tesla's allocation. One can only imagine what that will do to Bitcoin's price. Companies who allocate parts of their balance sheet to Bitcoin could see the price of Bitcoin increase instantaneously on the announcement, which means that at least on paper, the company gets more valuable instantly. So this entices more companies to do the same. And further, given 10 similar sized companies who all want to allocate, say, 5% of their balance sheet to Bitcoin, the first company to do so will have a larger impact on the price of Bitcoin than the 10th company, because by the time the 10th company comes around, Bitcoin's price would have gone up a lot already, and the law of large numbers would have kicked in. As in, the more market cap of a company or asset increases, it becomes harder and harder to grow at the same percentage rate, so the growth rate slows down. So not only is there an incentive for companies to buy and hold Bitcoin, there's an incentive to be among the first to do so. That being said, admittedly, it does require a critical mass of companies to allocate parts of their balance sheet to Bitcoin before the flywheel can really get kick-started. Personally, I had hoped that Tesla's move into Bitcoin would inspire other tech companies like Apple or Google to do the same. However, unfortunately, it appears that so far there isn't enough momentum to start this flywheel yet. Keep in mind, I'm not saying that companies need to put 100% of their balance sheet into Bitcoin. Companies do need to hold on to some cash in order to fund operations and for debt repayment if it has debt. But I think that for all the benefits of Bitcoin that we've just spent the last few weeks talking about, just a small 5 to 10% allocation isn't unreasonable. Bitcoin's ability to store value is the reason why it is beneficial for companies to use Bitcoin to preserve their purchasing power over anything else. It all depends on the nature of the business, I would say. Some businesses are hyper growth companies who can find a use of the cash and invest the cash back into the business to grow it. But if a company ever got to a point where it can no longer effectively invest the cash back into the business, then it faces a dilemma. It can return the capital back to shareholders in the form of a dividend. However, the problem with this, though, is that it effectively decapitalizes the company, meaning that once the cash is given back to its shareholders in dividends, the shareholders are not guaranteed to come back to the company. Once the shareholder receives the dividend, they can choose to invest the cash back into the company or go do something else with the money. So if the shareholder decides not to invest the money back into the company, that capital is lost forever from the company's perspective. But holding on to cash is also problematic since the company would be subject to the whims of inflation. This problem can somewhat be mitigated by converting the cash into US treasuries, which are government bonds that are considered risk-free. However, treasuries often yield less than inflation. So, net-net, the purchasing power of the cash still goes down over the long term. Some companies might try to employ alternative solutions such as investing the money into real estate. A company might go and buy a piece of land not because they need it, but just because it's a place to stash some wealth that will be resistant to inflation. This presents an issue for the people living in the area where the real estate is purchased because it would artificially drive up the price of other real estate in that area. Imagine if you were trying to buy real estate in a particular area, but the price is now out of your reach because some big company needed to stash their cash somewhere and decided to come in and corner off a huge piece of land and thus driving up the remaining real estate near the area where you wanted to buy. Wouldn't you be mad? In reality, though, this happens all the time, such as in my home country of Canada. Not only are companies hiding money in real estate in Canada, it happens on an individual level too. And I'm not blaming individual Canadians, or even companies for that matter, because I understand the issue. We need a place to guard against inflation, and bonds simply don't do the job as well as real estate. But the consequence of using real estate as a store of value is that it risks disenfranchising an entire generation of young people. Very few of my millennial peers are able to buy their own houses, and even less people I know from Gen Z are able to buy their own houses. The struggle of housing affordability is indeed something that is new, since it can be clearly demonstrated that the problem with housing affordability is clearly worse now than it was in previous generations. So, as you can see, the problem with finding a place to store value starts to bleed into other aspects of society that you might not have even thought of. Back to the example of a company trying to store value, the only thing left besides Bitcoin is gold. And we just spent an entire episode last week discussing why that wouldn't work. You'd either have to find a place to put it and hire someone to guard it, which would be expensive, or you'll have to buy paper claims of gold, which centralizes the control of your money to someone else. And even for a centralized service that issues paper claims on gold, they'll charge you a management fee too. So, in the end, the only real solution to this problem is Bitcoin. Admittedly, it might take a while for big institutions to think this through and really understand it, but once they do, I think you're going to see companies jumping into Bitcoin as their primary means to store value. The reason why Bitcoin should be preferred is, once again, the 6 properties of money, where Bitcoin has mastered 5 out of the 6 properties. And once enough companies, or just people in general, jump in, Bitcoin will have mastered the 6th property, acceptability, as well. Due to its similarities to gold, the first asset class that Bitcoin threatens to suck the market cap out of is gold. I will make a claim now that I want you to evaluate whether it is true or not. So the claim is, given any pair of technological solutions to a problem where one solution is digital and one solution is analog, the digital solution is always superior. In other words, if I have 2 things that does the same thing, but one is a digital version and one is an analog version, the digital one is always better. So for example, writing a letter is analog and sending an email is digital. A cassette tape is analog and an MP3 player is digital, or an MP3 file is digital. I'm saying that the digital version of the technology is always superior. So take a moment to think about whether this statement is true. Just think about if you're sending an email, is that better than handwriting a letter and mailing it in terms of cost, efficiency, whatever metrics you want to use? Is writing an email 10x better than sending a letter? Or maybe it's 100 times better. And let's just say if we can put a market cap on the entire concept of email and the entire concept of writing letters. If writing an email is only, say, 10x better than sending a letter, would it be crazy to assume that the email's market cap should be at least 2x the market cap of writing letters? So what I'm saying is Bitcoin is digital and gold is analog. Bitcoin might be 10x better than gold, or maybe it's 100x better than gold. I don't know. It's hard to say. But if we were to say that Bitcoin, as the digital solution, should capture 2x the market cap of the analog solution, then Bitcoin's market cap, shouldn't it be twice that of gold? Gold currently sits at a market cap of 11 trillion US dollars approximately. If Bitcoin were to reach the same market cap of $11 trillion, that would put the price of each individual Bitcoin at approximately $500,000 per Bitcoin. If Bitcoin reaches twice the market cap of gold, that would put Bitcoin at a total market cap of $22 trillion or just over $1 million per Bitcoin. And that's just the gold use case alone. Let's just say that Bitcoin goes on to suck some of the value out of bonds. Since why do you want to store your cash in bonds that don't even beat inflation when you can buy Bitcoin instead? The global bond market, as of the end of 2020, comes in at around $120 trillion. Every 10% of the global bond market that Bitcoin threatens to capture would be another $500,000 per Bitcoin of price increases. The global real estate market is even bigger, estimated to be around $326 trillion as of 2020. Now, granted, real estate has some intrinsic value since people live in it, so it's not something that is exclusively used for store of value. But if you think about what the percentage of the price of a piece of real estate in your favorite city that is used for the store of value use case, I would reckon that it's at least 5 to 10%. Meaning that if people didn't use their house as a store of value or as an investment to beat inflation, and they just purely looked at it as a place to live, how much cheaper would that piece of property be? So you can think about it in terms of a car, right? So people use a car as not as a store of value, since the price goes down. They see it as a utility. So they see it as something that you use for a specific use case, i.e. driving around. So when we don't use something for a store of value, like a car, then the price doesn't increase as much and we don't bid up the price. Of course, all of this is highly situational and it's hard for me to say, but my point is that Bitcoin is threatening to suck up all this value. This is because at the end of the day, Bitcoin was designed from the ground up to serve as a store of value, and every aspect of it was engineered to do this job perfectly. So once the value goes into Bitcoin, it does not go out because there is no other asset, at least in theory, that can store value as well as Bitcoin. This is what's called the Bitcoin black hole. Bitcoin is a black hole that threatens to decapitalize assets like gold, bonds, and eventually real estate. All right, I hope I've left you plenty to think about this week. I think this is a good time to end the show this week. Next week, we'll talk about inflation again and ask, is it necessary? Do we need inflation? And is deflation really as bad as what your economics teacher taught you? Find out next episode. For now, thank you all for listening. I will see you all next week. Bye-bye.